$28,500 per person per year. It's not the average American salary. It's not the annual cost of a decent public college. It's not even the price of a reasonably priced used car on the current market, where even a 2012 Civic is costing more than it should for reasons that also deserve a separate video. This is how much each man, woman, and child in the United States would need to spend every year, every single year, without fail to justify the market valuation of a single technology company. Let me repeat that, because I know you didn't believe me the first time. $8,500 per capita per year, taken from the pockets of 340 million Americans, including babies who can't yet speak, seniors who can barely use smartphones, and people in rural areas who have worse internet connections than some countries that Americans can't even locate on a map. And yet, Wall Street continues to smile. Analysts continue to put buy-in reports with the conviction of those who have never needed to justify anything to anyone. Funds continue to buy as if there were an adult in the room supervising the accounts. And your 401k? Your 401k is long on this too. Probably without anyone asking you if you agreed. Welcome to the greatest exercise in creative mathematics in American financial history, where the numbers don't need to add up, where logic is optional, where hype replaces the balance sheet and narrative is worth more than revenue. A place where analysts in expensive suits explain with serious faces why the old rules no longer apply, why this time is different, why you simply don't understand the long-term vision. If you think you're safe because you didn't buy this stock directly, is cheeky with me, because the most disturbing part of this story is precisely this. You're probably already in. You just weren't properly warned. Or they warned you in such tiny print that you'd need a microscope and the patience of a monk to read it. If this type of analysis is what you're looking for, without euphemisms, without brokerage sponsorship, without market cheerleading disguised as educational content, sign up now. The button is right below. Click it. Because what comes next will change how you view your portfolio, your retirement plan, and perhaps your faith in the efficiency of markets in general. Let's do some basic math. The kind they don't teach in those investment courses you bought for $400, presented by someone with an expensive watch and a fake office background on YouTube. For a company to be worth what its valuation says it's worth, it needs to generate revenue proportional to that value. Not tomorrow. Not in 20 years, with a generous discount rate applied by someone who will have retired long before they need to be held accountable. The discounted cash flow models that Wall Street uses have real mathematical limitations, and those limitations are being ignored in a way that would make your high school algebra teacher shed genuine tears over the state of financial education in this country. Think of it this way. If you own a pizzeria and I offer you $1 million for it, someone will ask basic and reasonable questions. How many pizzas do you sell per week? How much profit do you make per month after paying rent, ingredients, and employees? How many years will it take to recoup this investment with the current cash flow? Is there a realistic prospect for growth? Or are you at the limit of what the neighborhood can consume? This is called fundamental-based valuation. It's boring. It's laborious. It requires reading documents that are more than 3 pages long. And apparently it's completely out of fashion, since we discovered that you can call anything a platform and multiply the multiple by 10. Because what's happening now is different, simpler, and more frightening than any financial model. The price isn't being determined by what the company earns today. It's not being determined by what analyst project it will earn in 5 years, based on optimistic assumptions. It's being determined by what people believe others will be willing to pay in the future. It's the biggest idiot game, formalized, institutionalized, and sold with an annual management fee of 0.75%. The addressable market cannot support these numbers. The profit margin needed to sustain this valuation would require a level of market dominance that antitrust regulators themselves should already be investigating with far more seriousness than they are demonstrating. The growth rate implied in the current price requires the company to essentially swallow entire markets that don't even properly exist yet, but the numbers are still there. on the bright screen of your favorite investment app with a little green arrow pointing upwards and a percentage increase that looks good until you stop to ask where that increase is coming from. And do you know what the final ironic twist is in this situation? The same analysts who are publishing stratospheric price targets, who appeared on CNBC with an air of authority to explain why the company deserves every penny of its current valuation, are the same ones who, at some point in the future, will write a posthumous report explaining, in carefully chosen technical language, why no one could reasonably have predicted what happened, because external factors were unpredictable, because the macroeconomic environment changed in ways that no model adequately captured. Spoiler alert, everyone could have predicted it. The numbers were publicly available. Math wasn't a state secret. Some analysts and managers just have very concrete financial incentives not to say this out loud while the game is still in progress. Here's the part that will really bother you. The part that transforms this from an abstract financial market problem into something that directly affects the money you're saving for your retirement, for your children's education, for that emergency fund you've built up over years of financial discipline. You didn't need to consciously buy that stock. You didn't need to open a brokerage account and type in the ticker symbol. You didn't need to do absolutely anything deliberately and knowingly. All you needed was a 401k or an IRA invested in an index fund, or any ETF that tracks the S&P 500 or the Nasdaq or practically any broad American index. Because when a company becomes large enough in market capitalization, and an absurd valuation is precisely the mechanism that makes it large in terms of the index, it automatically enters the composition. And when it becomes part of the composition of the major indices, every passive fund that tracks those indices is mathematically obligated to buy proportionally, without questioning the fundamentals, without analyzing whether the valuation makes sense, without asking if the numbers add up when you do the math. It's automatic. It's mechanical. And it is precisely this mechanism that creates the most perverse and elegant cycle of modern financial capitalism. The price goes up because passive funds buy based on their weight in the index. The weight in the index increases because the market capitalization grew. The capitalization grew because the price went up. Passive funds buy more because the weight increased. Repeat this in a loop. Add billions of dollars in monthly contributions from American workers who are doing the right thing by saving for retirement. Put a management fee on top. Package it as a responsible, long-term investment product. Done! You, the worker who saves $200, $500, or $1,000 a month in your employer-sponsored retirement plan, are actively funding and sustaining the most detached from economic reality assessment the American market has produced in a long time. Not because you chose to speculate, not because you believe the company's narrative, but because the most common retirement savings system in the United States is structured in a way that leaves you no real choice. This has a technical name. Economists and market analysts call it forced buying. Compulsory buying induced by the index structure. You are an involuntary participant in something that, if you received an honest and complete description of what is happening, you might ask your benefits plan manager different questions. And here comes the cruelest part of this whole architecture, when this corrects with the violence that valuations detached from reality usually do. It will be precisely your 401k that will register the first and most visible drop. Large institutional funds have protection. They have hedging strategies. They have trading desks with algorithms that can initiate exits before the door becomes too small for everyone. They have derivative structures that protect the principal capital while participating in the rise. What exactly did you get? A push notification in your retirement app saying your balance decreased by 32% in the quarter, and a customer service phone number with an estimated wait time of 45 minutes. Have you liked the video yet? Do it now. And tell me in the comments, did you know your index fund had this exposure? Had you ever stopped to calculate how much of your money is in that specific position? I want to read what you're thinking, because this is exactly the kind of conversation that doesn't happen in corporate financial planning meetings. Let's do a quick historical memory exercise. Because Wall Street has selective and convenient amnesia, but you don't need to. And because the history of financial markets is essentially a collection of case studies on what happens when powerful narratives meet abundant money and an absence of adult skepticism. Tulips, Holland, 17th century. One flower, a single variety of flower, came to cost the equivalent of an entire house in Amsterdam. At the peak of the speculative mania, people sold real estate, physical properties, with walls and a roof to buy futures contracts for tulip bulbs. The argument was simple and familiar. There will always be someone willing to pay more because demand is growing and supply is limited. This argument worked perfectly until the day it stopped working. The market collapsed in a matter of weeks. The bulbs remained bulbs. The houses had already been sold. Enron, Houston, Texas. 2001. One of the largest energy companies in the United States, with operations on multiple continents, and a business structure so complex that even the executives themselves sometimes seemed confused when explaining where the profits came from. Wall Street analysts loved it. Institutional money was invested. Fortune magazine named it the most innovative company in America for 6 consecutive years. 6 straight years of innovation awards. When the creative accounting structure collapsed, mid and lower level employees lost entire retirement savings that were invested in company stock. The top executives have temporarily lost their freedom. It's a difference in treatment that the market never discusses very openly. Theranos, Silicon Valley, the health startup that promised to completely revolutionize medical diagnosis with technology capable of performing hundreds of blood tests from a single drop collected with a finger prick. A $9 billion valuation based on technology that the in-house engineers knew simply didn't work as promised. A board of directors composed of former secretaries of state, 4-star generals, and figures of immense institutional prestige. Sophisticated investors who should have done basic due diligence. Everyone bought into the narrative of the charismatic founder who would wear a black collar for the rest of her life like Steve Jobs. The technology was a fraud from the first to the last day of operation. Patients received incorrect test results with real medical consequences. Investors lost their money. The founder went to trial. The illustrious advisors went home without any major practical consequences. NFTs, 2021, 2022. Digital images of monkeys, with bored expressions being sold for hundreds of thousands and sometimes millions of dollars. Celebrities publicly endorsing them and buying them to show off on social media. Venture capital funds positioned in the most popular projects. Digital artists earning absurd amounts for work that could be copied with a right, but there was a certificate of ownership on the blockchain proving you owned the original of something infinitely rare. Everyone patiently explaining why this time there was real value, real utility. Why the underlying technology fundamentally changed the relationship with digital property. Today, you try to sell those same monkeys for a fraction of the price they were traded at their peak. If you can find a buyer who responds to the message, the pattern repeats itself with a consistency that would be almost admirable if it weren't so destructive. New technology or business structure new enough to be genuinely difficult to analyze for those outside the field. A powerful and emotionally resonant narrative that makes skepticism seem like a lack of vision or an inability to understand the future. Institutional money arriving early enough to create momentum and legitimize the movement. Retail money arriving late, attracted by past performance and the social pressure not to be left out. And then the uncomfortable silence when someone asked the simple question of where exactly the money went and who got it. The difference this time is not that it's different. The difference is that the scale is larger than any previous bubble in modern financial history. The volume of retirement money from ordinary American workers that is exposed is greater. The concentration in very few companies within the world's most widely followed indices is greater and more intense than in any previous episode. And the speed at which passive index mechanisms can amplify both the rise and the fall is something the market has yet to test in a full severe correction cycle. But this time, it's definitely different. It's always different when you're inside. It's always obvious that it was the same when you look from the outside after it's over. So what happens? In concrete terms, When this corrects with the force that challenged mathematics often eventually demands, markets that rise on index momentum and narrative rather than real fundamentals don't return to the mean in a polite and gradual way. They don't descend the escalator, giving everyone time to calmly reposition themselves. They fall in the elevator quickly, without adequate warning, with the door locked from the outside just when you want to get out. The downward mechanism is a perfect mirror image of the upward mechanism, which is why it's so violent. When indices start falling consistently, funds face waves of redemptions from frightened investors. To honor the redemptions, they need to sell positions. When they sell, the price of those positions falls even further. When the price falls further, more investors panic and request redemptions. The fund needs to sell more. The price falls even further. The revolving door that everyone used to enter gradually becomes a narrow door that everyone tries to use simultaneously to exit. Those who are the first to achieve real success are the ones with automated systems operating at speeds that humans cannot keep up with. Hedge funds with stop-loss algorithms calibrated to detect changes in momentum and execute exits in milliseconds. Proprietary trading desks of large banks with access to information flows that the average investor does not have. Executives from the companies themselves with pre-programmed sales plans that are technically legal precisely because they were planned in advance and do not constitute insider trading by regulatory definition. Those who are last to get out or who simply can't get out in time are the ones who check their 401k balance once a quarter because they're busy working, raising children, and trying to live a life that doesn't revolve entirely around monitoring market positions. It's not a design flaw, it's architecture. It's the system working exactly as it was built to work. But nobody explains that part in your employer's employee benefits program welcome material. And here is the cruelest and most predictable detail of this whole story. When Congress eventually convenes hearings with cameras and senators asking indignant questions for the historical record, when journalists from respected publications write lengthy post-collapse analysis articles, when personal finance podcasts dedicate entire series to trying to explain what happened and how to avoid it next time, no one with real power will be held accountable in proportion to the damage caused. Executives will have already executed sales through pre-programmed plans that lawyers have confirmed as legal. Analysts will present documentation showing that their reports contained appropriate disclaimer language. Fund managers will point to the 48-page prospectus that, in some paragraph, clearly stated that past performance is no guarantee of future returns. And you'll be sitting there with a retirement statement that looks like the electrocardiogram graph of someone with a serious medical condition, trying to understand how saving money in a disciplined and responsible way for years resulted in that number on the screen. The ultimate and most perfect irony of the current financial system is this. Structurally, it punishes the prudence of the average investor and rewards the speculation of those who have the resources to exit before the correction. It forces the conservative worker who only wants to retire with dignity to involuntarily finance the aggressive gambler who has hedge protection. It broadly and diffusely socializes risk among millions of retirement portfolios and privatizes profits in a concentrated way for those who were correctly positioned and had a guaranteed exit strategy. And it does all this with the emotionally positive language of democratizing investment, financial inclusion, and market access for all Americans regardless of income. $28,500 per person per year. This number isn't just a valuation that doesn't add up on paper. This number is a mirror. It reflects with brutal precision how disconnected the current financial market is from the economy, where real people earn real money, pay real bills, and try to build some level of financial security for their future and the future of their families. The next time an analyst appears on financial television with a well-produced presentation chart and an optimistic price target implying extraordinary returns, you have a concrete and simple choice. You can accept the narrative as it has always been presented, or you can ask three basic questions. Who is paying this analyst's salary and bonus? And what is the company's institutional interest in this position? Who directly and measurably benefits financially if you believe this narrative and act on it? And finally, most importantly, Do the numbers actually add up when you sit down and do the math without the stacked optimistic assumptions? If the answer to the last question is no, then you already know exactly what you're seeing. You're looking at a tulip with a startup logo, a valuation of 1.5 trillion, and a 2-3% position in your retirement index fund. If this video has changed how you think about what's in your portfolio, tell me in the comments now. Which historical bubble do you think this situation most resembles? I have my opinion, but I want to hear yours first. Like the video. It helps this content reach more people who need to hear this analysis before the next quarter's statement does the work for us. And the video that's playing on the screen now will show you another number that Wall Street would prefer you not stop to calculate. See you there.